This is Noah McIntosh with McIntosh Associates here for your market update. Well, are markets sensing the end with the Iran crisis? Markets ripped again last week. Despite persistent and climbing inflation readings, markets rallied to new highs, oil prices declined, and yields eased from increasingly alarming levels. It's almost as if the markets know something we don't, like this Iran crisis isn't going to end. There has been constant talk of imminent deals with nothing to show for, and we still have a ceasefire with a lot of firing going on. There's been talk that President Trump has reached an agreement for a 60-day ceasefire to negotiate further, which he had yet to approve as we closed out last week. It increasingly looks like there will be some kind of deal, but that doesn't feel like we're pursuing a very effective strategy at this point. Given the way markets are behaving, it looks like the crisis is quickly moving off the front burner. Oil has dropped to $90 a barrel after rising to 113 in early April, and definitely isn't a sign the situation is getting any worse. The 10-year Treasury had climbed to 4.66% on May 18th, but has come down to 4.47%, another signal the situation is improving. Markets also seem to ignore elevated inflation data with the improvements mentioned above. The vibe is that inflation will come down sooner rather than later. All this can go sideways quickly, but right now the markets seem to think this thing is over. Inflation has increased across the board. After seeing a rise in the consumer price index, producer price index, and now personal consumption expenditures, all three are aligned and not in a good way. CPI came in at 3.8% increase. PPI rose 6% at the last reading, which is concerning because the PPI is at the front to the middle of the pricing pipeline, and we haven't seen the full impact on the consumer or user end yet. How long can producers sit on higher material and energy costs before they pass them on to the rest of us? Well, the April PCE affirmed the April CPI reading, running a 3.8% year over year rate as well. If you're looking for a silver lining in any of these clouds, it just isn't there. Based on those readings, we could be in for some difficulties in the next few months unless a couple things happen in relatively short order. First and foremost, we need this Iran situation resolved in a durable and permanent manner. The non-ceasefire nonsense needs to end, as does the we're close to a deal any day now, and we'll wait as long as we need to language. We need a deal to be reached very soon. If we get that, oil will crater and bring down gas and energy prices with it. This will also drive inflation down to pre-crisis levels. The other thing that needs to happen is robust economic and wage growth to address the affordability complaints. If people have opportunities and see their wages going up, they won't feel the pinch of higher prices so much. This also helps when we're being constantly reminded about the price of gas being over $4 per gallon every time you pass a station. All of this contingent on a stable global oil market, which will be corrected once the Iran solution is sorted out, and a solid economy, which can have if the government stays open and out of the way. Every day that goes by without a resolution, we dig the hole a little deeper, and we know the deeper the hole, the harder it will be to dig out. Well, coming this week, now that inflation data, gross domestic product, and earnings are out of the way, we kick off a new month with employment readings. Employment has been one of the bright spots along with earnings during this entire Iranian crisis. Monday will be pretty quiet with a few Fed speakers constructing spending and auto sales. Jobs data will kick off on Tuesday when we see job openings and labor turnover summaries for April. The ADP employment report will be released on Wednesday. We'll also get the Fed Beige Book measuring economic conditions across the country, factory orders, and MBA mortgage applications. Thursday will feature jobless claims and first quarter U.S. productivity. Finally, we'll get the Bureau of Labor Statistics employment situation on Friday. Unemployment stood at 4.3% last month, with 115,000 new jobs reported and hourly wages rising at 3.6% annual rate. Inflation is at 3.8%, and wages need to rise accordingly to stay ahead. Wage growth lags or new jobs are soft, we could have some problems in the future. Well, that's it for your market update for this week. We'll be in your mailbox next week. Any questions, please give us a call, 989-692-2200. And as always, plenty of resources at focuswealthplan.com. Have a blessed week.